Hey, welcome back to the Matty Moolah channel. I guess I really don't need these headphones. I'm not talking to anyone, but just wanted to check in. I was just going to watch some videos, and I figured how else better to do this than maybe chat with you guys. And so it's just a one-on-one. No, Jackal, what's going on, my guy? It's just no Chris today. Just no Cashflow Chronicles. Just me hanging out and seeing how you guys are doing, and just looking at the market. You know, it was up 4% on the SPY this week. The Nasdaq 100 also did relatively well, and so it's been pretty cool. Oil's been kind of taking a tumble below the $80 mark, but it has recovered a little bit from the 72 back up to $76. Henry Hub gas below $3. Nvidia still hanging out before next week's earnings, just below 500. The bros recovered a little bit today. It was down 6% yesterday. Apple still hanging around $200. S&P 500 around 4,500. Palantir above $20. We'll talk about that a lot tonight at on Palantir Weekly. You guys are always tuning into that. Google just after less than a month back up to the 130s. Bitcoin still hanging out at 36,000, and so we are good. Hope things are well going for you guys. It was actually pretty funny. We had a local executive in town, and so with that, yesterday I saw my old boss, and he was like, I'm up on some of these positions, sometimes up, sometimes down. I was like, look, my guy, I was like, you can't get hurt taking a profit. So he was like, which one should I sell? And I was like, to be honest with you, because we were talking about, I think I told him a few of the stocks that I was buying into a month or two or a couple months ago. It wasn't a month or two ago. It was definitely longer than 3 or months ago or so. It was SLG, which he's done well on. It was Palantir. It was Rocket Lab. It was Dutch Bros. It was a few other companies, right? The ones that I'm somewhat convicted in and doing a really good job in, kind of timing, getting in, the last few months or so. And so I told him, I was like, SLG, it's like in my head, I was like, SLG still got a little bit of ways to run. I wouldn't want to get out of that before interest rates get cut, because I think that's going to have a little bit of a tailwind when that happens. Bros, man, I think Bros is still going. But Palantir, I'm like, if you were to look at the most overvalued one of those 4 or 5 positions that I kind of mentioned, Palantir is the one. And I'm sure we'll talk about it tonight. No, I didn't tell him to put it all into cash, and I don't believe that we are in a session. So if you guys didn't see me and Chris's, it was a constructive debate, right? We weren't screaming at each other. It was very well, I think, back and forth about why we think each other is wrong with respect to an upcoming recession. I thought that was really well, tastefully done. I see where Chris is right in some of those things, and I hope he sees the same about where I think I'm coming from. I think the recession was last year, and for those of you guys, it was literally really well done. Like that hour went by so fast yesterday, and I think that overall, we just have a little bit of time. But yeah, I think Palantir right here, a little bit overvalued. I think with just the increased share count and going into the 20s, it's just a lot right here. So there's that. But I'm just going to hop into some of these clips that I wanted to watch for the day, and you guys can chat in the comment section on the right, and we can also have just a quick conversation once those kind of come through, if I see anything pretty cool.
Joining us now is Bob Elliott from Unlimited. And Bob, you might not be alone in saying not so fast. I want to play this for you. Here's Boston Fed President Susan Collins on inflation.
3-month core is still at 3.4%, Steve. That's higher than we want. And so in order to get back down to 2% in a reasonable amount of time, we need to be patient and resolute. And I wouldn't take additional firming off the table. We need to look holistically at the data.
So is that bad news, you think, for people who are long now, or just reason not to get longer?
Well, I think if you look at what's driven the market rally on the stock side over the course, really since October 31st, it's been that move in bonds, right? Long end bonds are up about 8%, stocks are up about 8%. And there's a reason why that is because the Treasury effectively indicated easing through the QRA announcement. And then on top of it, we got a bit softer inflation prints.
He's basically saying that, yields for the 5-year and 10-year were up close to eclipsing 5%, and some people are thinking that they might even go to 5.5%. And so with that, the recent kind of pullback by the FOMC kind of saying, we are kind of at our peak, we're kind of hitting the pause button, and it's very unlikely we're going to kind of change that. You ended up seeing a lot of rallying over the past week with respect to just yields coming down, and with yields coming down means a lot more input into stocks most of the time. So that's kind of been the bullish theory over the past week and a half.
Than expected. You put those two things together, I think people are thinking there's a very quick shift to easing by the Fed, and now we're starting to see cuts priced into March even, right? The initial cuts in 2024, and I think
that's early. March is a little early, I think.
There's an appropriate amount of temperance being conveyed there, which is, the road is long to bring inflation durably back down to 2%, durably being that key point. And I think the Fed recognizes that a few prints aren't necessarily going to say, hey, mission accomplished, everything's over, particularly when the labor markets are still pretty tight and wage pressures are still elevated relative to where they were before COVID started.
I guess the counter to that is we've already got the brakes on with rates having risen so high as quickly as they have. And even if we don't get cuts in March, if inflation continues to come down to a surprising degree, like we've seen up to this point, maybe the market doesn't care if we don't get cuts in March.
Well, I think that's certainly a possibility. The challenge is if the Fed doesn't deliver the cuts, then you're going to start to see that move up in bond yields, right? Because the Fed needs to deliver the cuts in order to meet the market's expectations of between 4 and 5 cuts next year. No cuts, bond yields move up, and that's the exact thing that is detrimental to the stock market that's been so beneficial over the course of the last couple of weeks.
Well, that's what we saw bond yields fall so much this week, not because the Fed cut, but because inflation was lighter than expected. So in a way, doesn't lighter inflation reads, cooler reads, doesn't that substitute for a Fed cut sooner?
Well, I think the basic question is what's going to cause the Fed to cut? Will softer inflation cause them to move to ease monetary policy? Or are they looking at the overall picture of the economy and saying, hey, look, the economy's still pretty strong. Why waste your ammo today? Why juice asset returns today when instead, as long as the economy's doing okay, hold policy the way that it is and wait until...
That's a lot. See, like I'm looking at UBS saying almost 3 percentage points cut in 2024. Dang. See, I'm more along the lines of what Goldman's thinking, like a late. See, I think that we'll start cutting in like the June, July timeframe in the summertime, but 3 percentage points, probably why nobody banks at UBS. No, I'm just kidding. I'm more along. How do I say this? I'm going to combine the two of what Goldman. I've been thinking about 25 basis points, and originally when I was kind of thinking about this, because I'm always going to be wrong, right? Like if you guys look at when I was like late 2021, early 22, like my terminal federal funds rate was like 2.5 to 3%. Your boy was wrong, right? But I also didn't recognize how sticky inflation was, right? I was drinking the Kool-Aid when it came to just being like, oh, it's transitory and all of that. So with respect to that, hey, June, hey, D. Edwards, thanks for stopping by. Just an impromptu little guy. So we'll see if this sticks on the docket. I work from home on Fridays, so we'll see if this sticks on the docket. It'd be cool to come in at a little bit after hours, after close, and chat with you guys. I don't know. Like I don't see it being as late as the fourth quarter of next year, but I do agree with 25 basis points per quarter because I think that leads you into, hey, you're cutting. And if you need to cut half a percentage point, it still leaves that on the table. Versus if you cut 50, say, basis points per quarter initially, then it, you can't really come back because that's going to be a huge put basically if you were to be like, oh, we're doing 50 basis points and then pull back to 25, right? So I think 25 is cautious. I think 25 is good. I think it starts in middle of next year. I don't know what the fuck UBS is smoking. Sorry for my language, but Jesus Christ, almost 3 300 basis points or 3 percentage points in 2024, I would love that. I'll refinance my mortgage. Like, it'll be great. I'll also refinance the mortgage that I have on the rental property. If that's if that's what they're doing, you know, I would welcome that wholly, and I would probably get some money stacked up between now and in the first half of next year to buy some more rental properties if that's the case. I just don't think that 300 basis points is happening personally. But let's continue, because he talks a little bit about oil in this clip.
You have to engage in that easing. Wait until there is actually a downturn before you start to implement it. That's where the ordering is.
I agree, right? You know, you need a little bit of, you know, you can ease on the brakes a little bit, but, you know, you don't want to just let it open up fully, right? Because we've kind of been in that situation for the last several years of being like, well, do we do negative interest rates because we need something, you know, to kick the economy into gear? And we've kind of been stuck in that rock and a hard place.
Is very important. First, conditions are going to deteriorate, and then the Fed is going to ease. And I think people are getting ahead of themselves, you know, starting to position for the backside before the first couple of steps happen.
Yeah, I just wonder whether we have to actually get the cuts to experience in the equity market the effect of cuts, but I'll leave that alone. So got to talk gold, because you're a big gold fan, pointing out how much.
I think you guys said, listen to me, I'm not a big gold bug, but I think there's times and opportunities.
If you had been holding it in your portfolio since 2020, it would have reduced volatility for you. But given where we are now, can we count on gold continuing to have that effect over the next 3 years?
Well, I think the main thing to remember about gold is non-interest bearing money.
See, for those of the people that are like really bullish about gold, gold's been kind of flat, you know, plus or minus 5-10%. So when he talks about reducing volatility, gold spiked up in like September 2019 with the whole COVID thing, and it's been pretty flat ever since. I mean, it's gone up to 2000 and it's been down to 1750, but it hasn't really been really flying off the shelves in terms of price per ounce.
And it's been impressive how much gold has held up in the context of long-term real interest rates rising 300 basis points. Now, they might rise a bit further. That might be a bit of a drag on gold from there. But eventually, you're going to have a situation where the Fed is going to have to deliver easier monetary policy. And holding gold in your portfolio may prove to be even better than holding treasuries because of that sensitivity and benefit when real rates start to.
See, I just don't. Gold does this thing, and maybe I'm wrong here, but gold does this thing where it goes through years of consolidation, it pulls back, people start to get a little like, but to be in a place where we're going to start, this is just me speaking. I'm not a mastermind at gold or anything like that, but you know, my parents have a little bit of it just in case, you know, they were more about gold than they were about the stock market. I just don't believe in it. I'm a Warren Buffett kind of believer when it comes to the gold piece. So just the way I look at it is it's like, it doesn't make sense, right? It's something that's used as a commodity. It's like buying oil. It's like buying oil producers when everything, you know, is down. It makes sense. And even buying gold when it was down, you know, $1,100, $1,200 before September of 2019, you know, made sense. But here at 2000, when it's kind of leveling off, I think you need to have a pullback before it moves up. And to me, gold always moves in like these big waves, right? Where there's nobody's very bullish about gold, and then next thing you know, it's going up into the right direction. So to me, when like gold is super out of favor and it's pulled back, you know, 20-30% from its recent highs, that's a time to start like accumulating a little bit if you're into it. I'm not a big fan of it personally, but because that's when you start getting some consolidation, people stop spending less. It's like oil, right? Anytime you have a very large pullback in oil, like if oil were to start getting into the $50-$60 range here from where it's been, it'd probably be a good time to accumulate some oil assets. But I just don't think right now is the most prudent time, because you're still on some pretty good economics for a lot of oil and gas production. I think it's the same for gold personally.
Fall on the backside. So from a strategic asset allocation, gold is really beneficial because it basically operates in a way that's very opposite to what stocks do.
What do you make of the impact of the drop in oil prices?
Well, it's hard to suggest that there's been a big macroeconomic driver causing the oil price market to move so swiftly downwards. And so what it's looking like is more a paper sell-off, where I think in some ways people are inferring from the bond market and the yield moves that are happening in the bond market that that we're having a negative growth environment, and then that's translating somewhat mechanistically into the oil market in futures positioning and paper positioning. I think the challenge with that is that the reason why we're getting the move down in the bond yields is because people are expecting easier monetary policy, right, which should actually be beneficial to growth over time. And so I think people are looking at sort of a traditional intermarket action dynamic and not recognizing the actual fundamental cause of that bond yield move is actually supportive to oil rather than detrimental to it.
So you don't think oil goes down much further, it sounds like?
I think there's a real opportunity here in terms of from a skew perspective. As we know, OPEC Plus is meeting shortly. They've already taken 1 million barrels a day off the market. If this oil sell-off gets any further, you have a combination of OPEC